A few weeks ago, the Russian central bank surprised many by raising its interest rate by 100 basis points, bringing it up to 19%. This move was aimed at dealing with stubborn inflation, which remains high with no sign of decreasing. The bank's latest forecast expects inflation to hit 7.3% for the year, well above the target of 4%. Elvira Nabiullina, head of the central bank, mentioned that during their meeting they even considered raising the rate to 20%, depending on the most recent data. Meanwhile, the government now expects the economy to grow by 3.9% in 2024, an improvement from the earlier 2.8% forecast in April. However, this still marks a slowdown from the 4.6% growth in the first half of 2024. This slower growth is not because people are spending less, but mainly due to supply shortages and weather demand from abroad. Western sanctions have played a big role in disrupting trade, with Russia's key partners adding pressure to the economy. Nabiullina also highlighted that cross-border payments have become more difficult in recent months. The central bank's plan, shared last month, suggested that high interest rates will need to stick around for a while to bring inflation down. One reason for the inflation spike is the rapid rise in corporate lending, which increased to 2.3% in July from 1.5% in June, even with the high interest rates in place. The next central bank meeting is set for October the 25th, and many analysts think another rate hike could be on the table. Nabiullina added that figures from next year's draft budget, which will be released soon, will also influence future decisions. Oleg Kamen, an analyst at Renaissance Capital, pointed out that the recent rate hike shows a clear intention to keep raising rates in October if needed. The Russian central bank has raised interest rates 7 times in the past 14 months, in sharp contrast to many other economies. Following Russia's invasion of Ukraine, inflation rose globally due to several factors. The invasion itself accelerated the rise in commodity prices, which had already been climbing since the end of COVID-19 restrictions. As demand increased worldwide, prices for essential goods like food and energy spiked. To counter this inflation, many countries raised interest rates, making borrowing more expensive. This slowed down demand as individuals and businesses began cutting back on spending. As a result, inflation started to ease in those economies. However, Russia has experienced the opposite trend. Following the invasion of Ukraine, the Russian central bank reacted by drastically increasing its interest rate to an emergency level of 20% on February 28, 2022. This sharp hike was designed to stabilize the economy in response to the immediate fallout from international sanctions imposed on the country. These sanctions severely limited Russia's trade and financial interactions with its key partners. Despite the initial increase, the central bank quickly lowered rates in response to improving conditions. By April 8, 2022, just over a month after the initial hike, the rate was reduced to 17%. A series of further cuts followed in quick succession, with the interest rate dropping to 14% by April 29th, 11% on May 26th, 9.5% by June 10th, and finally settling at 7.5% on September 16th, 2022. These rapid reductions were likely an effort to support domestic economic activity, which has been hampered by the sanctions and the ongoing war. For nearly a year, Russia maintained this lower rate of 7.5%, signaling some level of stability. However, by July 21, 2023, the Russian central bank reversed course, raising rates to 8.5%. This marked the beginning of a series of rate hikes as inflation pressures continued to mount. On August 15, 2023, the rate jumped to 12%, followed by another increase of 13.3% on September 15th, and then to 15% on October 27, 2023. As inflation persisted, the central bank raised the rate again to 16% by December 15, 2023. By July 26, 2024, the rate had climbed to 18%, and the most recent increase to 19% came at September 13, 2024. This series of increases brings Russia's current interest rate just 1% below the emergency level introduced right after the Ukraine invasion. The fact that the central bank is once again approaching emergency level interest rates suggests there are ongoing, significant problems within the Russian economy. The persistent rise in rates indicates that inflation remains a major issue, one that central bank is struggling to contain. This continued inflation, despite repeated interest rate hikes, points to deep-rooted issues including supply chain disruptions and sanctions that have limited Russia's ability to engage in global trade. Elvira Nabiullina, the head of the central bank, has commented on the deteriorating situation with cross-border payments, another significant pressure on the Russian economy. The sanctions imposed on Russia have made it increasingly difficult for the country to engage in international financial transactions, further restricting trade and investing flows. While the government has been promoting GDP growth figures, claiming an expected increase of 3.9% in 2024, up from earlier estimates of 2.8%, these figures point toward the underlying economic struggles. The recent GDP growth is primarily driven by domestic demand rather than external trade. Supply-side constraints and reduced demand from trading partners are significant factors weighing down the economy. The Russian central bank has indicated that a tight monetary policy is likely to remain in place for the foreseeable future. As long as inflation remains high and external pressures persist, further rate hikes could be on the horizon. The next central bank meeting, scheduled for October the 25th, 2024, is already being watched closely by analysts, with many speculating that another increase could be in store. Oleg Kamen, an analyst at Renaissance Capital, has pointed out that the recent rate hikes signal a clear intent by the central bank to continue raising rates if necessary. When comparing Russia's current interest rate of 19% to the other G20 countries, it's clear Russia is in a difficult position. Only Turkey and Argentina have higher rates, with Turkey at 50% and Argentina at 40%. Both of these countries are in the middle of severe economic crisis, where inflation has spiraled out of control, forcing them to dramatically hike their interest rates. The fact that Russia is right behind these two countries shows there are serious problems in the Russian economy as well. Russia's high rate stands out, especially when compared to the rest of the G20. Aside from Turkey and Argentina, only Mexico and Brazil have double-digit interest rates, with Mexico at 10.75% and Brazil at 10.5%. While these countries are also dealing with economic challenges, they are still better off than Russia in terms of inflation control. Most other economies in the G20 are actually seeing inflation and interest rates slowly coming down. The fact that Russia's rates are rising shows that it is moving in the opposite direction, still grappling with deep economic issues. Looking beyond the G20, the global picture does not look any better for Russia. Russia's interest rate is the 15th highest in the world, even higher than countries like Pakistan, Gambia, Haiti, Kazakhstan, Mozambique, and Uzbekistan. This makes it clear that Russia is in serious trouble. While these other countries are also struggling with the economies, the fact that Russia's interest rate is higher than theirs speaks volumes about the severity of its challenges. In many countries, rates are expected to drop as inflation cools down. For example, Brazil's interest rate is forecast to fall by 8.75% by the end of 2024 and even further to 8.50% by 2025. Similarly, Mexico's rate is expected to lower to 9.75% by 2024 and continue dropping to 9.50% by 2025. Meanwhile, Russia's high rate shows no signs of dropping soon, reflecting ongoing inflation pressures and the impact of sanctions. The fact that Russia's interest rate is so high indicates serious underlying issues. The central bank is trying to control inflation, but it is clear that deeper problems persist in the economy. Sanctions, disrupted trade, and overall instability are driving these high rates, and it remains uncertain whether these measures will be enough to stabilize the situation. The rest of the world seems to be moving forward, while Russia continues to struggle with its economic challenges. The main reason Russia has been raising interest rates is to combat its persistently high inflation. In August 2023, inflation was at 5.2%, which was already above the central bank's target of 4%. While inflation seemed somewhat under control at that point, things quickly changed. Despite rising interest rates, inflation began to rise. By November 2023, it had reached 7.5% and stayed around that level until February 2024, when it ticked up to 7.7%. Inflation kept rising through 2024. By May, it had increased to 8.3%, reaching 8.6% in June, and then jumping to 9.1% in July. This marked more than double the target rate set by the central bank. Even though the central bank raised the interest rate from 16% to 18% in July 2024, inflation remained high, staying at 9.1% in August. In response to this constant inflation, the central bank decided to raise the interest rate again in September 2024, this time by 100 basis points, bringing it up to 19%. The central bank's struggle to bring inflation down indicates that more rate hikes could be on the horizon. Some analysts believe that Russia may push its interest rate even higher, possibly surpassing the emergency level of 20% that was introduced in February 2022 following the onset of the war in Ukraine. One key metric to watch when predicting what might happen with inflation over the next 3 to 6 months is the movement in producer prices, also known as factory gate prices. These prices reflect how much companies are charging for their goods at the production level before they reach the stores. When producer prices rise, it's a strong signal that consumer prices will likely increase in the near future as the costs eventually pass through to customers. In August 2023, producer prices in Russia were rising by 10.6%, a rate significantly higher than the actual inflation rate of 5.2%. This gap between producer prices and inflation indicates that inflation was likely to rise as higher costs at the production level would soon be reflected in the prices consumers pay. And indeed, inflation increased in the months that followed. Producer prices saw a sharp spike in the last quarter of 2023. By November 2023, producer prices were rising year-on-year by 21.9%, which is one of the major factors driving inflation in Russia. The sanctions placed on Russia have cut off access to many imported goods, making the country more dependent on domestic production. When domestic production costs rise, as seen with a 22% increase in producer prices, those higher costs inevitably lead to an increase in consumer prices, which pushes up inflation. Producer prices continued to rise in December 2023, increasing by over 19%. In the first few months of 2024, the rate of increase started to slow slightly, but it remained high. By April 2024, producer prices were up by 18.4% year-on-year, 16.2% in May, 14% in June, and 13.7% in July. While the rate of increase has moderated compared to the sharp spike at the end of 2023, producer prices are still growing at a rate of 4.6% higher than the official inflation rate. This tells us that inflation is not likely to ease in the short term, as the higher production costs will continue to be passed on to consumers over the coming months. Given this trend in producer prices, it's clear that Russia will likely face continued inflationary pressures. With producer prices still rising much faster than inflation itself, it's expected that consumer prices will increase, making it difficult for the central bank to bring inflation under control anytime soon.